Okay, let's just imagine for a second. You've just come into a significant amount of money.
Right.
Could be an inheritance, a big bonus, you sold something, and it's just sitting there. You know you need to invest it, but then that huge question hits you.
Instantly.
Do I put it all in the market right now, a lump sum investment, or do I, play it safe and spread it out over a few months? That's dollar cost averaging, or DCA.
And that moment right there, that's where the rational, numbers-driven part of your brain goes to war
Yeah.
with the emotional human side that's terrified of loss.
It's a huge dilemma. It can cause total paralysis.
Oh, absolutely. The fear of just getting the timing wrong can stop people in their tracks for years.
And that paralysis is exactly what we're here to break through today. Our mission is to do a deep dive into the data, for sure, LS versus DCA. But the real key, the real breakthrough, is looking at the one factor that actually determines your success.
And that's your own psychology.
Yeah.
Yeah, because I think the biggest mistake people make is they look at the charts, they see the average return, and they think, that'll be me. But it won't. You don't live the average. You have to be ready for the extremes.
It reminds me of that quote from the trader Richard Dennis.
Oh, the legendary one.
Yeah.
You must expect the unexpected in the stock market. Be ready for the extremes.
That's the one. And that's the tension we're exploring today, the gap between what the stats say should happen and what it feels like when a personal catastrophe hits. So before we jump in, just our usual quick reminder, this is all educational, it's informative, based on a ton of research and experience.
But it is not personalized investment advice.
Definitely not. You have to take these ideas, I think it was Charlie Munger who said this, and use your own brain to assemble them for your own life, your own goals.
A crucial step.
Okay. So let's start with the hard numbers, the part that honestly surprises a lot of people.
Right.
If you look strictly at the historical data, there is a clear statistical winner, and that winner is lump sum investing.
It's pretty unequivocal, really. I mean, the research on this goes back decades, and the reason is actually pretty simple. The stock market, over the long run, goes up more often than it goes down.
About 75% of the time, right?
Something like that, yeah. So if you've got cash sitting on the sidelines, waiting for this perfect moment, you're statistically just delaying your exposure to the market's natural upward drift.
It just comes back to that old saying we always hear, time in the market beats timing the market.
It really does. Getting that lump sum in there just gives your money more time to compound. That's the engine of growth, even if there's some short-term choppiness.
And we're not just saying this. There's some really solid research to back this up.
Oh, yeah. We dug into what's probably the most definitive study on this. It's from Vanguard Research called Cost Averaging. Invest now or temporarily hold your cash.
Okay, and what makes that particular study so powerful?
It's the sheer scope of it. They didn't just look at one market during one good period.
Let's pause on that because I think this is where the statistical proof really gets its weight. What did they actually analyze?
So they took a global view. They covered 3 huge markets, the US, the UK, and Australia. And the time frame they used was massive, from 1976 all the way to 2022.
Wow. Okay, so that's not just a bull run. That includes some massive downturns.
It includes everything. The dot-com crash, the 2008 global financial crisis, the COVID dip in 2020, it's all in there.
And how did they actually compare the two strategies?
They ran over 1,000 different rolling 10-year scenarios. So it's like simulating 1,000 different people getting a windfall at 1,000 different times. And they tested lump sum against DCA over 3, 6, and 12 months.
Across different portfolios too, right? Not just stocks.
Yep, 100% stocks, the classic 60-40, even a 40-60 mix. It was incredibly thorough.
And after all that, what was the final score?
The finding was really consistent. Lump sum investing won in about 68% of all the cases they tested.
So 2/3 of the time?
Roughly. And to put a number on it, for a 100% stock portfolio, the lump sum approach, on average, gave a return that was 2.2% higher than DCA over just 1 year.
Okay, so let me get this straight. The numbers are crystal clear. 2 times out of 3, lump sum wins. And it wins by a pretty decent margin.
That's what the data says.
Then why are we even having this conversation? I mean, why would anyone choose the option that loses most of the time? What makes that other 30%, that 1 out of 3 chance, so bad that we even talk about DCA?
Because that 30% is where people get wiped out psychologically. It's where they panic. See, statistics give you the average result over 1,000 lifetimes. But you, listening right now, you only get to live your one unique experience. And if your experience is investing a huge sum of money right before a massive crash,
Then the statistically superior strategy becomes a personal disaster.
It becomes behaviorally disastrous.
Exactly.
Let's make that real. Let's say you invested, I don't know, $100,000 in like October 2007.
Oof. Bad timing. Horrible timing. A few months later, the great financial crisis is in full swing, and you're watching that 100 grand turn into 50,000. Maybe even 40.
That is a terrifying thing to watch in real time, especially with money that's new to the market. It transforms a theoretical risk on a chart into an emotional emergency.
Our sources called it emotionally and psychologically devastating.
And that's not an exaggeration. The loss just feels so much more intense than any equivalent gain would feel good.
That's loss aversion, right? The behavioral bias.
Precisely. The pain of losing $50,000 is felt about twice as strongly as the joy of gaining $50,000. And when that pain is immediate, it feels psychologically unbearable. That's the term they use.
And when something becomes unbearable, what do? You make it stop. You sell.
You sell. You abandon the plan. You're maybe 6 months in, and you're convinced you're a terrible investor or the system is broken, and you pull your money out.
Right at the bottom of the market.
And in doing that, you crystallize a colossal loss. The very strategy that was statistically better has led you to financial ruin because you couldn't handle the stress.
That perfectly explains the quote we found from our fictional persona, Sandra. She said, "The statistics are nice, but if I hit the market at the wrong time, I risk dragging that like a burden for a long time."
And she's not just talking about the money there. She's talking about the mental and emotional baggage. That's what sabotages long-term performance.
So the best strategy isn't the one with the best average return.
No. The best investment strategy, by a mile, is the one you can actually stick with for decades, through the good times and the bad. If your optimal strategy makes you bail during the first bad patch, it was the wrong strategy for you.
Okay, so this totally reframes the debate. We should probably stop thinking of DCA as a performance strategy at all.
I think we have to. Its true value isn't maximizing returns. It's a behavioral safety mechanism. It's a psychological guardrail.
A guardrail. I like that.
Even the Vanguard study, which proves lump sum is statistically better, it validates using DCA specifically for risk management, for managing emotions.
That makes so much sense. By putting the money in bit by bit, you're managing the risk of that terrible timing. If the market tanks 20% in the first month,
You haven't lost 20% of your entire windfall.
right, you still have most of it ready to be deployed at those new lower prices in the months to come.
Exactly. It softens the blow. It stops you from panicking, and it helps you do the single most important thing in investing.
Which is?
Staying invested, period. That's the #1 factor for long-term success. DCA is just a tool to help you manage your emotions so you don't break that golden rule.
So even if DCA earns you, on average, 2% less over a year, that's infinitely better than being so scared of volatility that you just keep your money in cash and never invest at all.
And the research is very clear on that point. It says DCA is preferable to cash and is especially suited for investors who are, by their nature, averse to big, immediate losses.
So the conclusion seems pretty clear. The choice isn't based on a universal rule from a textbook. It depends entirely on the psychological makeup of the investor.
It's all about your own risk tolerance.
Okay, but how do we help someone bridge that gap? Someone who's listening right now, they've got that windfall, they know they're loss averse, but they also don't want to miss out on that 70% chance that the market just goes up.
Well, that's where the most practical piece of advice from our sources comes in. If the idea of a lump sum is just too much to bear, you have to break it up. But the suggestion is to place that excess cash into a strategic reserve.
A strategic reserve. I like the sound of that. What does that actually mean, though? Are we just talking about a checking account?
Not quite. It needs to be somewhere safe, low risk, and emotionally neutral. Something not in the stock market. Think high-yield savings accounts, maybe some very short-term treasury bills, a money market fund.
So the goal isn't to make a huge return on that reserve.
No, not at all. The goal is to park it somewhere you won't worry about it, so you can stabilize your own emotions while that money waits to be deployed.
It's like a decompression chamber for your money. You isolate the big, scary number, and then you can just commit to your DCA plan, say, 10% a month from that reserve.
Precisely. You turn this huge source of anxiety into a lever that you control. You get to control the speed. It means you're respecting the statistical odds by getting into the market, but you're also respecting your own behavioral limits.
You're not exposing yourself to an unbearable risk.
You're not.
So what does this all mean for you, the person listening? We've seen the stats. 7 out of 10 times, you should just invest the lump sum.
But we've also seen that if you're one of those other three, your natural human wiring, that loss aversion, is probably going to cause you to make a really, really bad mistake.
So the key takeaways are?
What? I'd say three things. First, accept the statistical truth. Lump sum is usually more profitable. Second, acknowledge the behavioral truth. Lump sum is way riskier emotionally.
Especially for new money.
Absolutely. And third, use DCA, or that strategic reserve idea, not to chase returns, but as a discipline tool. A way to make sure you pick a method you can actually follow without panicking when the market does what it does.
At the end of the day, it's your call. It really goes back to that Munger quote. You have the data, you have the psychology, you have the practical tools. Now you have to use your own brain to assemble it all for your situation.
And keep learning. The only way you win this game in the long run is by staying in it. That's the ultimate truth.
We really hope this deep dive has helped frame this big decision for you and helps you honor your own psychology just as much as you honor the statistics.
That's the goal.
And as always, just a final reminder that this is for educational purposes. It's not personalized investment advice. You're responsible for your own research and your own choices.
Absolutely.
If this discussion has gotten you thinking about how smart investing can help you buy back your own time to move towards financial independence, we'd love to know. Comment below with just one word: freedom. If this has inspired you to work toward buying back your own freedom through investing, let us know.
A red idea.
And while you're down there, please add a like to this deep dive and make sure you subscribe to the channel. That way you won't miss any of our future explorations. We'll see you next time.